Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, stocks are making above average returns and bonds are eking out 1%. Geopolitics continued, of course, but more importantly, corporate earnings continued to be robust. Interest rates are mostly range bound, steady. Inflation remains elevated. At quarter end, U.S. large company stocks lag the pack at a positive 10% return. Overseas companies are pushing 15%, and U.S. small companies lead with an astounding 23%. Bonds are holding so far with a 1% return. It may be time to recall that the long-term return on stocks is 10% per Ibbotson's SBBI. We are in a period of vast technological advances with vast uncertainty on resulting productivity and vast exuberance in the market's crystal ball. Let's move through the U.S. economy, corporate earnings, interest rates, overseas, and how the portfolios are holding. First quarter GDP, gross domestic product, came in at 2%. The Atlanta Federal Reserve's GDP Now tool is forecasting 1.2% for second quarter of 26. But that statistic shifts frequently. For context, the last 5 years GDP growth rates have been 2.1%, 2.8%, 2.5%, 2.1%, and 5.8% back in 2021. Consumer spending remains steady with a strong jump in May. Projections remain for moderate growth. Job growth in June was down to 57,000 on the tails of May's 172,000 new jobs. Unemployment dropped to 4.2% in June, but mainly because the labor pool got smaller, the denominator. Inflation is 3.5% to 4% annually now. I think we all notice that in the prices we're paying. It's far above the 2% target. Tariffs, yes, those are still ongoing, and the on-again and off-again war with Iran and its impact on oil prices, gasoline, and more continue to make elevated prices and inflation a good bet. Here's the shining star on news. Corporate earnings remain awesome and came in at positive 29% growth in the first quarter versus a 13% forecast. Earnings are predicted to grow 23% in the second quarter, mostly in technology and energy companies. The annual growth for 26 is now forecast at 24%, much higher than previous. This ameliorates the intense market updraft we've just witnessed. Price-earnings ratio, a measure of how much investors pay for a dollar of earnings, usually range 12 to 22 times historically. The current ratio on forward earnings is 20 times. Not crazy yet, but at the top. The Federal Reserve has a new chairman, but interest rate changes are governed by the 12-member Federal Open Market Committee. The federal funds rate remains unchanged in 2026 at 3.5%. The intent is to balance inflation and the labor force. A lower rate usually boosts labor and jobs. A higher rate retards inflation. War remains in Ukraine, Russia, and in Iran. These impact markets, oil companies, defense stocks, commodities, oil, gold, and bonds to some extent. Investors are staying in the ring, assessing how the short-term daily news impacts stock prices while balancing it with the longer-term anticipation of AI's productivity increases. The short and long term are both unknowns. What's on the horizon? 2026 and next year have reasonable price-earnings ratios given the rate of corporate profits growth. Yet corporations, mostly tech companies, are taking on lots of debt and investors are buying. That's a lot of risk when we don't know how far AI's technological advances will improve productivity. Once productivity improvements are seen to broaden beyond tech to more brick-and-mortar companies, investors can start to gauge how much productivity and profit increases can result. Most pros don't know the timeline on that yet, so uncertainty and risk remain. The volatile geopolitics are a risk, but only when they meaningfully impact earnings or interest rates. We have a great deal of diversification drilled into our portfolios. Our small caps and overseas stocks are paying off this year. You can see that from the year-to-date index returns above. Our bonds are beating the index and providing stability, but we're getting a low return there. It's easier to appreciate those when stocks are losing money, as they were earlier this year. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.